pattern recognition, it's an incredibly important part of the puzzle. What we're really looking for are psychological patterns that repeat themselves in the marketplace. They do so time and time and time again. And we know them by various names. We call them triangles or wedges or double bottoms or head and shoulders or whatever names. But what they are is simply descriptions of basic psychological phenomenon. The interplay between greed and fear, the shift over time from being totally greedy because the stock is going to go to the moon to being totally fearful that the stock is going to go to zero. In the microcosm, that plays out in terms of very small shifts in psychology during the trading day, in terms of bigger shifts in psychology that are played out on the daily charts, and in terms of the giant long-term shifts in psychology that are played out on the weekly and monthly charts. So it's a very interesting process to look at the patterns and such, but it only really makes sense if you try to think of them as modeling the basic underlying psychology. And that's the real key to the puzzle. None of these things are artifacts in and of themselves. All they are is reflections of people. They're tracks in the snow, if you will. So securities create these patterns repeatedly, time and again. And really, that's not a correct statement. It's people create these patterns in securities time and time again because it's their basic interplay that creates the patterns. The best pattern recognition engine is undoubtedly the pattern recognition engine that you were born with. It's your eyes and your brain and the ability to pick signal out of the noise, to be able to sort out the daily interplay and be able to identify the key turning points that are important to you as an investor. The bottom line here is in any given environment, there are a limited number of good opportunities, places to transact where the risk-reward relationships are properly balanced in your favor. And what we need to do is identify the patterns that those opportunities represent. Trust your well-informed eye, and well-informed is the key. What we are doing with Bollinger Bands, with percent B, with bandwidth, with the other indicators that we're talking about, is we're informing the eye. We're adding a framework that allows us to see what's actually happening, to separate the signal from the noise. That's the crux of the matter. There's nothing magical about Bollinger Bands or intraday intensity or accumulation distribution or percent B or any of the rest of it. At their most basic function, think of these as visual aids that allow you to see and recognize and take advantage of opportunities as they create themselves in the marketplace. Exceptions can and do occur. Please be prepared. That means recognize that there are no absolutes. We're not going to get to a perfect system. We're not going to get to an environment in which all of our decisions are correct, in which everything that we do is right. There are always going to be problems, and be prepared to deal with them. For some people, that means using stops. For some people, that means hedging, using options. For other people, that means having a great number of securities in the portfolio to provide diversification. it means different things to many different people. But at its most elemental, it means be aware that you're not dealing with a perfect system and that you will need to clean up after it. Really, to the extent that you clean up with it after it is the extent that you will be successful. I've heard say, for instance, about chandelier stops, that if one just picked trades essentially at random, that chandelier stops are robust enough that just by the use of random entry in chandelier stops, you can generate a profitable portfolio because they separate the winners from the losers in an asymmetric manner, right? And they keep the losers relatively small, and they let the winners run to a greater extent, so that if you just practiced random entry and used chandelier stops, that you would be able to enjoy positive investment performance. I don't know that that's true. I haven't tested that phenomenon, but the idea is probably correct in that it focuses the attention on the necessity of dealing with the downside as well as the upside. The old saw on the street is take care of the downside and the upside will take care of itself. You know, that's probably an overstatement, but it's a hint in the right direction. It's some people use fundamentals to take care of the upside. They buy stocks that they feel are going to have real long, good records of earnings growth and good corporate governance in front of them, and they simply try to find the best entry points and let the rest of it fall where they will. That's very much like the Warren Buffett style of approach. He's essentially using the fundamentals as his stops, in that it won't let him into stocks that he feels will have inferior performance. So can and do be prepared for the downside, whatever that means to you. And it's going to mean something different to everybody here. The stock markets top in very, very typical patterns. Patterns that you will see repeated time and time and time again. 3 pushes to a high. 1, 2, 3. You see this over and over again. I'm going to show you a bunch of other examples where you'll see exactly this type of pattern. One big push, pull back. Another big push, pull back. One final push, and then it's over. Why this is, it's very hard to say. R.N. Elliott suggested that this modeled the basic human psychological process, the way that we interact with our internal beings. That may be true. It's hard to say, but nonetheless, we see these patterns repeat again and again and again and again. You give me a chart book with 100 stocks in it, and I'll find you 50 examples of 3 pushes to a high, and I'll find you 50 examples of double bottoms. They're that common. They're going to be all over the place. And with the framework that we give you, you'll be able to diagnose these very easily, and they'll pop into high relief. If I hadn't labeled this and then pointed it out with my pointer and I said 3 pushes to a high, you know, there might have been a lot of argument, a lot of debate in this room as to exactly what 3 pushes to a high meant. Was it these 3 pushes? 1, 2, 3. You know, was it these 3? I mean, how did that work? I labeled this because I saw some other things that allowed me to label it that way, and it was very clear to me. And I'll try to teach you how to see things that clearly. Here's your classic double bottom, right? Typical bottom in the form of a capital letter W. Time and time and time again. The most common bottoming process is a W bottom. The most common topping process is 3 pushes to a high. We see them over and over again. Now, where it gets interesting is sometimes these patterns repeat themselves. Sometimes these patterns are evident at different levels of magnitude. A mathematician would call this fractal. That is, if you take a look at the whole and you see a given pattern, and then if you zoom in and look at a higher magnification, if you see that pattern repeated again, and then you zoom in again and you see that pattern repeated again, that's called a fractal quality. It means that the same basic price formation mechanism is evident on the hourly chart, as is evident on the daily chart, as is evident on the weekly chart. And we can see fractals in many, many ways. Here you have an example of a big W bottom, and right in the middle of the W is a little M formation. And I can't help but every time I look at a double bottom, I always look to see if this is there. It gives me that added bit of confidence that I'm seeing the price formation mechanism correctly. And you'll see this again in succeeding examples.
Is there any relevance to whether the first one being different?
The question is, with these W's, do they have to occur at the same level, or does it matter if the first one's lower than the second one, or the second one's lower than the first one? The answer is yes, and the way you sort them out is by using Bollinger Bands. And so sometimes one will be, sometimes you'll see an example where the lowest low comes on the left-hand side and the lowest low comes on the right-hand side, and that's a good pattern. And sometimes you'll see the opposite, and that's also a good pattern. But then sometimes you can find an example of both of those patterns that aren't good patterns. What we're going to do is we're going to define these W's in terms of their relationship to Bollinger Bands, and that's how we're going to identify them. So, typically what will happen is the first piece of confirmation that we'll look for is volume confirmation. Here's our first low. Note a couple of things. First of all, it's outside of the lower Bollinger Band. So what's the value of percent B here? Below 0. All right. And there's a huge amount of volume in connection with this big low. So we'll have a lot of a kind of indication that this may be a capitulation low, right? A washout, where the last people who are the weakest hands have been cleared away, and there really are only strong players left, and perhaps maybe there's some accumulation coming. So we come up and we make a little rally. See, there's the M inside the W, right there. Often see that. We make a little rally, come back, fail near the middle band, often will happen. We'll come back and retest. This time, we're not able to get outside of the lower band. So what's the value of percent B here? A small number, like 0.2 or 0.3 or something like that. But remember, it was a large negative number over here. So we have a divergence in terms of percent B, and much less volume. We didn't even get volume over the average on this retest. Rally back, fail at the moving average, come back and retest once more. Again, lower volume than on the initial push. It is a little bit higher than here, but I don't think it's enough to worry. So we'll have a W bottom in place here. Come back and retest. All right? Everything's looking pretty good. Both of these tests occurred inside the bands. What are we going to do? We're going to wait for price to confirm. We're going to wait for a signal that our analysis is correct. That occurs either here when we cross the average, or better yet, here when we really power up. Notice at that moment we'll have very high volume, and we'll go all the way from the middle band to the upper band. In fact, we get outside of the upper band. That is called a sign of strength, or an SOS. And we'll deal with the characteristics of signs of strength at length tomorrow. But they are our triggers. They let us know that we have conducted our analysis correctly. All right. We'll have a W bottom in place here. There's a little W within the context of the bigger W. So we have a little fractal quality here, a little W in the context of the bigger W. And volume confirms. Strongest volume on the first push down, weak volume on the two subsequent retests, and outside the band, inside the band, inside the band. So that's our fact set. What are we doing? We're building up an indictment. As soon as we get confirmation that our evidence process is correct, we'll then buy, and then we participate in this nice rally. In order to clarify this puzzle, we can start to add indicators to help us recognize these patterns. We've already talked about this sign of strength here, and I've drawn a little arrow here to call your attention to the really much larger than average volume. So we have our sign of strength here. But is there a way that we could have had even more confidence in this trade? Remember, we built up a long list of facts here. Here's a potential capitulation low. Here's a retest on lower volume. The low is outside the bands. The retest is inside the bands. Here's our sign of strength. Here's a momentum indicator, just a very simple momentum indicator. In this case, it's Wells-Wilder's relative strength index. Right? And clearly, momentum on the low was at 30, beneath 30, bounced back to 50, which is where we ran during the consolidation period, and then as soon as we turn up here, the sign of strength, we cross 50, and we'll have a divergence here. The momentum indicator, even though we've come back and retested the lows, the momentum indicator has not fallen to the same type of levels that were seen on the initial lows. So here's another piece of confirmation, is this idea. And I just drew a little trend line on here to draw your eye to the divergence. So that's really where we're going. The whole idea of what we're going to do is to compare price action within the framework of Bollinger Bands to the price action, to the action of volume and the action of indicators, and to combine these parts and pieces together into a rigorous trading system. Here's a categorization of W patterns. This was done by Art and Merrill. The first work on this was done by a fellow by the name of Levy, Robert Levy. It was done in 1970 in a paper he did in which he developed this type of categorization. He didn't categorize them as such. That was done by Art Merrill 10 years later. But he suggested that all price movements could be broken into a series of 4 moves connected by 5 points. And he called his paper 5-point patterns. Art Merrill broke them down into this pattern where the the points in the patterns are ordered by the height of them. So to give you an example, this being the highest point would be 1. This being the second highest point would be 2. This being the third highest point would be 3. This would be 4, and this would be 5. So if one were to describe this pattern, one would describe it as 1, 3, 2, 5, 4. The order in which they occur. Likewise, the strongest upside pattern would be 4, the fourth lowest point comes first, 5, the lowest point comes second, 2, 3, 1. So we have 5, 4, 2, 3, 1. And so he ordered them by the order that they came in, from the weakest pattern to the strongest pattern. And if you look carefully, you'll see some of the patterns that you're familiar with. Here's, for example, a classic wedge pattern, a triangle as it's often called. And this is a kind of classic W bottom, huh? Here's a even more classic W bottom. So Arthur Merrill just ordered these sets of points so that we could apply a rigorous methodology to naming our patterns. Is it a W bottom? Well, what kind of W bottom is it? And then knowing what kind of W bottom it is, we can test and see how that relates to subsequent price action. So there are 16 possible W patterns ranked from the weakest to the strongest. And there are 16 possible M patterns, again, ranked from the weakest to the strongest. Well, Merrill would have categorized this as a falling pattern, a descending pattern, downtrend, and would have categorized this as an uptrend. Here's our double, here's a nice double top. Right? And you can see a head and shoulders could be constructed from these pretty well by inferring the immediately prior move. So, for instance, if you look at a W9 here, if you were to draw this line and this line, you'd have a head and shoulders pattern. So you can extend this idea to most phases of market analysis. And here's how the categorizations go. Uptrends are M15 and M16. Downtrends, W14 and W16. Just come back here. Uptrends, W14 and W16 would be right here and right here. All the patterns, all the points in the pattern are in ascending order. Make a steady walk up.
Is there 3 pushes to the high end?
You'd have to combine 2 patterns to get 3 pushes to a high. One too many. One too many. So 3 pushes to a high would be like a W16 and 1 more leg. Or an M16 and 1 more leg would be a 3 pushes to a high. Could be an M15 also. So we have uptrends, M15 and 16, W14 and 16. We'll have downtrends, M1 and 3, and W1 and 2. So W1 and 2 are our downtrends. And here are our downtrends for the M's. Here's the other one, M3. And they're defined by the fact that the 3 points are in order. just as this is an uptrend, its 3 points are in order, rising order, and here's the other uptrend. Its 3 points are in rising order. Head and shoulders, you have to imply the 2 extra line segments because it's a 7-point pattern, not a 5-point pattern. If you take your basic head and shoulders pattern, it's 1, 2, 3, 4, 5, 6 line segments connected by 1, 2, 3, 4, 5, 6, 7 points. So in order to see it as an M or a W, you have to imply these 2 line segments. Inverted head and shoulders, the same thing, just the opposite formations. And then the 2 triangles, an M13 and a W4. And then let's go look at the 2 broadening formations, because we sometimes see a lot of them. So M5 and W2, W12. So there's W12. The last swing encompasses all of the prior pattern. So it's basically each swing is getting larger, a broadening formation. And then it's the M5 is the broadening formation. Each swing is getting longer. So those are formations of increasing volatility. Right? And they often mark the end of trends, where you come up and make a high. The 3 pushes to a high will often be terminated in these type of broadening formations. This will be the final formation. Now, M and W reversals. Stocks and markets rarely turn on a dime. The most typical bottom formation is the double bottom. The most typical top formation is 3 pushes to a high. Often, 3 pushes to a high is the first 2/3 of a head and shoulders pattern. For example, if we come with something like this, 3 pushes to a high, and then the next swing, and there all of a sudden you have your head and shoulders pattern with a shoulder here, a head here, and a shoulder here. But these highs, 1, 2, and 3, are the termination of the move. Here you have just the final retest showing that we're completely out of steam, and then the breakdown. In a little while we're going to talk about this rally back that often happens, and then the subsequent sell back. This rally back after a head and shoulders, and I'll show you a couple examples of it, and also after a W, is by far and away the highest risk-reward trade that I know of. It is the best entry point that I have ever been able to find in the markets. To short a stock. Or the other way. But I'll show you real examples of it. So most typical top formation is 3 pushes to a high, which is often the entry to a head and shoulders. Here's the drawing of an ideal W, done much in the same formation as we did the how to find the best moving average. Typically what would happen if you have an average that's descriptive of the intermediate trend, you'll come down, you'll make a primary low, you'll rally back to the average, fail there, go back down, retest the low, break the average, completing the W. You know, this just is kind of the signature that you should keep in your mind. What happens a great deal is that we break this average by a real meaningful piece. Sometimes we'll go all the way back up to the upper band and then come down and retest. Another thing that happens is what we saw before, where over here you have a second retest. So there's a W here instead of just this V-type formation. So time and time again, you will see variations on this pattern. The basic idea is that you come down, you make an important low, rally back, retest that low, maybe a little lower, maybe a little higher, turn back, take out the average, and then head into a new phase of market activity. It's the signature of a market in a transition. Now, somebody asked before about, do these things need to occur at given levels? And the answer is no. They don't need to occur at given levels. They occur in many different ways. Here's a classic example. Come down, make a low, rally back, big rally back, come back, retest, and then go. Big, big go. Look here. Here's a nice little W within the bigger W. And then here's a little W within the bigger W. Time and time again, you'll see these little patterns within the bigger patterns. We call them fractals. You can think of them as you will. But when I see them, they always give me a little bit more confidence in the price pattern. It tells me that, that what's happening in the macrocosm is also happening in the microcosm. It's just a little bit of an aid to the pattern recognition process. Here's another classic W. This one occurs at the same level. You come down and retest exactly the same price. Turn. Here's your sign of strength telling you that, in fact, the pattern is over. And then here's the opposite, all right, where this retest occurs at a lower level. And then look here, in the retest, there's a little W. So this fractal quality plays in time and time again. Again, this is a pattern that you would buy the expansion day. We're not going to try to buy the lows and buy the highs. There's a story they tell about a god with a small g that rules the trading pits in Chicago. And it's a very simple-minded god. It has but a couple of rules. It says you're allowed to buy the very bottom tick once in your life. And you're allowed to sell the very top tick once in your life. You're free to do the converse as often as you would like. So we're not really trying to buy the lows here, and we're not really trying to sell the highs. We're trying to identify the patterns that happen at the lows and highs and then take action as soon as we have enough evidence to assure ourselves that the pattern is complete. That means that by definition, we're going to be late. We're not going to buy, this guy right here. We're going to buy up here. We're not going to buy this guy. We're going to buy somewhere later in the process. We're not going to sell this guy, but we may well sell this one. Right. We're always going to be a little bit later because we want the odds to be in our favor. Remember our two dimensions, the percentage of winners versus the size of the winners. To increase the percentage of the winners, we want to be a little bit later, right? So we can be a little bit surer and keep on pushing our percentage of winning trades up. Now, here's a typical example of trying to diagnose a pattern where the second low is beneath the first low. Now, here comes a stock. It comes down, it makes a panic low here, and it turns up higher, Actually has a very nice run and then comes crashing right back down to the lows. These are pretty big moves on this stock here. I mean, we're talking about 25% or more swings here. It takes out the prior low. And you know what the news is on this day, right? Wireless makes a new low, right? Yes, percentage B is higher. Exactly the point. We've made a new absolute low in terms of price here, but we have not made a new relative low. We're at the Bollinger Band here, but we have a big piece of distance between us and the Bollinger Band there. So it's a new absolute low, but not a new relative low. And the gentleman made the point perfectly. He said percentage B is higher on the second low. And that's how we diagnose it. We don't just say, oh yeah, it's a new relative low and go on. We need a way of being able to convince our computers to recognize this stuff. So in this case, new low, percentage B is higher on the second low, even though price has made a new low. And you know that everybody on the planet was looking at this when this happened. You know, every trader was saying, yeah, there they go, ripping out their new lows. It's going to zero. All right. So here's the capitulation. Big day in the market, very big day in the market. Quiet down for a couple of days, turn higher. There's your sign of strength telling you that it's okay to get in. You're going to see this chart twice. Now I'm going to tell you that there is nothing that we can do about this. This is simply, at the level of our knowledge now, this is simply undiagnosable. We'll come down, we make a low outside of the lower band, bounce back in, come down, retag. We'll have a working W bottom here. We'll come down, again, retest, and the retest goes outside of the lower band. Percent B is lower here on the right-hand side than it was on the left-hand side. Given what we know at this moment, we cannot buy this pattern. When this sign of strength here shows up, we just go, we pass, because it doesn't fit our methodology. Later, we'll come back and revisit this chart. Remember, it's Ashland. After we've introduced some indicators, and we'll show you a technique whereby, even given this type of problem, you can successfully diagnose a pattern of this type. This is a very interesting question. Given that it's a sign of strength, and you made such a huge move that day, where do you get in? Some people have the fortitude to wait for the pullback and buy the pullback. I don't. I just buy the sign of strength and say, but it's easy to figure out during the day that this is going to be a sign of strength day. When you're like halfway up in this pattern, you know, you've already turned big volume, and you can see that it's going to be a sign of strength day. You don't necessarily have to wait to the close. But some people actually have the fortitude to wait a couple days and wait for the pullback.
And you'd be looking for a pullback maybe midway to the tall bar there?
Yeah, but it's not.
Yeah, it didn't happen in this case.
Well, you got a little pullback here. Well, it came back to the, yeah, it did.
So maybe you're waiting for 50% back and you never get it.
Yeah, I buy the sign of strength. That's my discipline, is to buy the sign of strength. But the wonderful thing about this business is, you know, people always ask me, how come it is you can teach these systems and they still go on working? Well, the fact is that I'm going to teach you tomorrow, I'm going to teach you 3 trading systems, rigorous trading systems that you could go out and employ literally. but not a single one of you is going to do it. Not one person in this room is going to do it. You're all going to say, well, you know, I'm going to wait for the pullback. Or I'm going to use 19-day bars. Or I'm going to use 2.5 deviation ding-dongs. Or I don't like that intraday intensity. I like MFI instead. And, you know, the daily bars, they just don't make it for me. I'm going to use 2-day bars. Each of you is going to take the material that I give you here, and you're going to go home and you're going to fashion your own approach. And that is a wonderful thing, because it means that you're going to fashion an approach that you can live with, an approach whose risk and reward criteria match yours and that you will be able to execute. You won't be able to execute my approaches because they're my approaches. They're suited for me. But you're going to go home and you're going to tweak these and you're going to bend them. And there's, what are there, 40-some odd people in here. And we're going to get 40-some odd different approaches. First of all, half of you are going to say the squeeze, nah, not me. The other half are going to say trend recognition, nah, not me. That's too late for me. And some of you are going to say, oh, those reversal patterns, yeah, I really like those. So each of you, first of all, you're going to cut up the material and you're just going to pick the parts and pieces you liked. And then you're going to tweak those parts and pieces so that if you came back and showed them to me in a month, I wouldn't recognize them. Right? But again, it's a wonderful thing because what I'm dealing in is tools. I'm not dealing in religion. Right? I'm not teaching you the Holy Grail, the way to salvation here. You know, I'm teaching you a bunch of tools that you can use to accomplish your own purposes. And to the extent that you do that is to the extent that you will get the true value out of this seminar. So, we shall see. If anybody takes any piece of this and deploys it exactly as taught and is still doing that a month from now, yet to tweak any of it, call me up and tell me I was wrong. My phone won't be ringing off the hook. Yeah.
You know, we talked briefly about when to get in, but that's the easy part, I think. The hardest part...
When to get out is coming.
Yeah.
It's coming. We're talking just about recognizing the patterns and picking the trades now. Outs are coming. But to deal with the problem of how do we get out, it's for many people who do this, they simply turn it upside down. That is, the entry patterns that they use, they just couple them with a similar strategy on the other side and a reasonable set of stops. And that's all they do. Entry and exit techniques are really separate entities. But if you're cool enough with your stops, which means you actually use them, so if you actually deploy your stops, then to a large extent, you can be a little bit easier on working on your exit techniques because, well, you'll see the chandelier is a wonderful thing. It's really great. Then here's where it gets really hard to diagnose. In this area, you have a W bottom, nicely put together. They're both of them inside the bands. And indeed, here's your sign of strength coming out of it. I just don't know what to tell you about this. This is really in the land of the undiagnosed. It's kind of a sloppy formation. There wasn't enough oomph into the low to really flush everybody out, and there really isn't all that much bounce coming out of the highs, out of the formation here. It's just kind of a sloppy formation, and it's the kind of formation that I ignore. I want my patterns to be as clean as possible, and this just simply isn't very clean. But this is very clean. Here's a classic W bottom. The stock is chevron. You come down, you make a low outside of the band on huge volume. Huge volume. You come back, you fail near the moving average, you come down and retest. You don't make a new low either on an absolute or a relative basis. You turn back up and then look at the volume expand on the 2 expansion days. Then look at the bandwidth expand. Remember before rocket motor, big expansion in big expansion in bandwidth? There you have it. 2 big expansion days to the upside. Huge volume driving them. Giant expansion in volatility. And you come up, the bottom band turns up. That means that this stage of the process is over. You go sideways for a while, you break to the upside, you pull back, and then you get another leg up. So the rocket motor tells you all throughout this period to err on the side of higher prices. W bottom, beautifully confirmed, rocket out of it. Even though you consolidate, you're all during this period, you're looking to err on the side of higher prices. So essentially, the rocket motor tells you to look for this expansion. This one's very troublesome in that the consolidation takes a long time, but nonetheless, you get the big push out of it. And I purposely picked some of these charts to be troubling. I didn't want the perfect examples. I chose this one because of this big choppy range after the liftoff and then the positive resolution, to give you an idea of the kinds of frustration that you're going to run in your day-to-day operations.
Excuse me, would that month and a half, 2-month consolidation, would you just stay in the stock long? Or would you maybe exit on one of the highs? And then go back into it when your charts are better?
The question is during this consolidation, would you stay in it? And a lot of that would have to do with your long-term view. If you were long-term constructive, if you had reasons to own the stock, you thought that the oil environment was right, you thought that the war against terrorism was going to disrupt the oil fields or whatever, if you had some information that kind of helped you, that would help you stay in this stock. After this, though, you could easily sell the highs and work on buying the lows because you've had this rocket motor takeoff that tells you that you'll really, when you get these lower band tags, you really ought to buy these because you've got a perfect W bottom behind you and rocket motor. So all of these look like entry points to me in light of this bit of action. So a lot of it has to do with your outlook on the stock. Some people walked away in frustration, I'm sure, and that's not a bad thing because there were probably other opportunities that were easier to exploit. Yeah?
You see the left side on BOBB, or
Oh, yeah, that's a great question. One of the things, if we could see more of the price structure back here, I wonder if this was sitting right on a lot of support. Something like that. Other kinds of evidence that you could bring into play. I have no idea what the case is, but yes.
When you had that push-up, you would wind up buying on a gap up?
No, this is your first. This is the strong day. This is your sign of strength.
Right, but that'd be one bar, one day.
Yeah, but that's the day I would buy.
When you get the strength that day.
Yeah, that's the day I would buy.
also on that,
W bottom perfectly behind you. Big expansion in volume, sign of strength. Buy on that day. Stop underneath the previous low.
and that big day push day up, does it usually show up on the Bollinger as the bottom?
Yeah, when you get this rocket motor, almost always the lower band will turn down.
That's a positive sign.
Yes, that's a very positive sign. The lower band turning down against the trend is a very positive sign. It means that there's momentum in well, how does it put it? It means, to me, it means that there's momentum in excess of the trend. You know, that there's more energy built up in the system than is evident yet. Springboard's deeply depressed. Been deeply depressed here. And then here is your classic head and shoulders bottom. Not all bottoms are W's. Sometimes you get more complex bottoms. And here is a perfect example, and an example of as good an entry point as you are ever going to get in this business. And I mean that. And when you see this pattern, trade it. Okay. Down, up. There's the first part of the pattern. Down to a new low, back up to the neckline that was established before. We got 2/3 of a head and shoulders in place now. Back down, no new low, back up, break the neckline. Neckline, broken. Rally up, pull back to the neckline. Bingo. It doesn't get any better in terms of risk-reward ratio than it gets there. Your stop is right underneath, because you know if it takes out the neckline, then the pattern's busted and you want to be someplace else anyway. So it's a relatively small amount of risk, just in this case a couple of points for big gain. You'll see these patterns again and again and again. If you walk away with nothing else from this seminar but the ability to spot these reentry point patterns, these, I call them throwbacks. Typically what will happen is you'll come up, you'll pull back, you'll come up, you'll pull back, you'll come up, you'll pull back. There's your neckline. You'll break the neckline, and then I call this a throwback rally. And then as soon as you turn down from that throwback rally, remember, we're waiting for confirmation in our direction. As soon as you turn down from that throwback rally, that right there is the best entry point that I know about. They're hard to find. I mean, there aren't millions of them lying around, but when you see one, you kind of know what to do. And then, you know, the Bollinger Bands will be really helpful here because they'll come up, this will be outside, this will be at, this will be beneath, this one will be, you know, the middle band will come through like this, and then this will be down here, and then, you know, like that. So you'll shift from being in the upper band as this formation goes to being in the lower band, and his throwback rally will just carry you back to like the 20-day, carry you back to the middle of the formation. So the Bollinger Bands will help you define that. So in this case, the throwback rally stops right at the lower band and the neckline. It all comes together right there. And then immediately you get a sign of strength coming out of the throwback, and then you walk up the upper band. You'll see this after W's too. It doesn't have to be, you know, it's the same drill. After a W, you get the same thing. Back in the old days of overheads, I could just turn these over, right? And you'd see, well, it's still, you can still kind of see it, right? Right? The W double top and the throwback. See, that's the one thing about this new piece of technology. That was a basic technique. You could show the, you know, you had to draw the charts once, and then you could just flip them over.
Isn't that similar to a cup and handle, though?
The question is, these throwback, either in this case it's a throwback decline, or where you really get them, that I love them, is on the upside, throwback rallies to tops. Whether they're better as head and shoulders or W's or M's. I think they're probably better as head and shoulders. I don't know the proper answer, but my guess is that they're probably better as head and shoulders because head and shoulders are more massive top formations. and or bottom formations. They have more to them. There's more action in them. There's kind of a little bit more power inside them, if you will. They've taken more time. You've covered more price. You've shaken more people out. There's been more change in ownership. So I think it's more fertile the larger the pattern. Really not whether it's an M or a W or a head and shoulders inverted or plain. But I think the larger the pattern, probably more successful they are. So here's the ideal head and shoulders top, left shoulder, head, right shoulder, decline, break the neckline. Here's your throwback rally. That's the sweet spot right there. Sometimes this line will be a little bit sloped this way. Sometimes it'll be a little sloped this way. It's never going to be perfect, right? So I drew this idealized picture. If you can kind of print that in your head, and when you see them show up on the charts, just remember that you need to wait for the price to actually turn down, right? Don't try to sell into here. Sell over here. Wait for it to complete. Even the next day. Just get up there and break.
Lower low, lower high.
Yeah, that'd be great. Lower low and lower high. That would be good evidence. A little volume on the downside. You know, a little shake them up. A little bad news and sell off accompanying the bad news. You know, the idea here is that this is the first wave of euphoria, right? And then this is the first piece of bad news. Then, you know, the euphoria continues and the next piece of bad news happens. Then, you know, the euphoria is really strung out. There's not much left here. Next piece of bad news. And then, you know, whatever last piece of bad news, and just struggle back to the neckline. And then, after here, there are no more happy shareholders. You know the old saw about no more unhappy shareholders? When a stock's making new highs, everybody owns it at a profit, so there are no unhappy shareholders. Well, over here, there are no happy shareholders. All right? Well, except the shorts, right? So here's an actual head and shoulders top in Vichy. Come up. 1, 2, 3, draw it around, sell it off, throwback rally, wango. And look at this, a second chance. How often do you get that? Well, the answer is actually, if you look at a lot of these charts, there often is a second entry point. You know, you'll get the first leg down, and then you get another try. And generally, it won't get this high. Generally, it'll fail in the vicinity of the old low, maybe a little bit up into it. This is a little bit stronger than most, but then, you know, it rolls over, and it rolls over, and it rolls over. And, you know, when you get this type of massive top formation, and it's completed like this, the downside potential is very strong because there genuinely are no happy shareholders anymore. There's only unhappy shareholders. And price action on the downside pries them out, pries the stock out. Just keeps on bringing it out. Here's a head and shoulders top. I really wanted to illustrate it within the context of Bollinger Bands. And also, this one has a sloping neckline. Very common. The neckline does not have to be flat, right? It can be any way it wants to be, but the basic psychology is there. Upper band, pull back, upper band, pull back, upper band, pull back. Oops. And you'll see later I have a chart that I've actually labeled this particular move, oops, because it tried to get back to the upper band and it couldn't. Turn down, sell off, a little bit of support at the neckline, then breaks it. No freebie here, it just goes to hell in a handbasket. Just quick deceleration to the downside. You know, so it's okay to sell these breaks of the neckline no problem at all. But beware that, in a fair number of occurrences, you rally back to test the neckline. So if you come down a little bit and then start back up, that's a great place to cover and see if you're going to get a better reentry point. But often you get this, they come out of these patterns, these top formations, and they just go straight down. Here's a classic. Remember, let's go back, head and shoulders. 1, 2, 3 pushes to a high. 1, 2, 3 pushes to a high. A head and shoulders is the subset. The basic pattern is 3 pushes to a high. Right. So here's an example of that. 3 pushes to a high. 1, 2, 3. Here's the break. Here's the throwback rally, and then the collapse.
Well, they are severe.
This pattern you'll be able to find time and time and time again. Come up, come up, come up, break, lower band broken here, lower band broken there, rally back. That's a perfect entry place. Absolutely perfect entry place. Right. Sell off, bounce off. Here's a throwback entry into a sell without the head and shoulders top. Same theme, just another variation. The market's going to present it to you in 100 different ways, but the same idea is going to play every time. You make a top, you come back and test it, and then you roll over and die. Here it is. 1, 2, 3 pushes to a high, roll over, big sell-off, come back to the breakdown point, turn down. If I call the big day on the upside a sign of strength, what do you think I call this? Sign of weakness, a sow. So the SOS and a sow. And, that's exactly what would happen if you dropped a sow from this level. It would just fall.